Good evening, everybody. And for those who have actually joined in from parts of the world where it's still an afternoon, so good afternoon to you. We are gonna have a quick recall of what we did in the yesterday's class, and then what we are gonna do is that we are going to take a short break for namaz, and then we will resume our class. So I would recall what we did in the yesterday's class. What we did in the yesterday's class was simply we discussed the basic overall of the syllabus, that what exactly is the P7 syllabus all about, and how is it examined. And in addition to this, I did discuss about the overall audit approach, that what exactly audit involves and what are the various steps of the audit. That's what we discussed. In addition to this, what we did was we did actually talk about that the audit has got various stages, and what are the various stages of the audit. So the various steps of the audit actually include the tendering for the audit, and we actually discussed that tendering for the audit actually means that you are giving a quotation to the client. That's what is considered to be tendering for the audit. Then we talked about the engagement letter signing and what exactly is an engagement letter signing, the terms and conditions that you have discussed with the client. Those terms and conditions are actually documented. So those documented, and the documented letter is being signed, so that becomes a contract between you and the client. So that's actually an engagement letter. Then we talked about the next stage, which is the audit planning. We discussed that the audit planning stage involves multiple things, which includes the overall audit strategy, the timings, the direction, understanding of the entity and the environment, the risk of material misstatement being identified. Then we talked that once you are done with the planning stage, then the next stage that comes in is the performance stage of the audit. And what does performance stage involves? So the performance stage actually involves that you perform the audit procedure, gather the audit evidence. That's what the performance stage involves. The objective is to gather sufficient and appropriate audit evidence, and then we actually discussed about the finalization of audit. And finalization of audit actually involved that the senior manager or partner is going to review senior management or partner is going to review the financial statements, the working papers, and would actually tell you that sufficient or appropriate audit evidence has been obtained or not. If it's being obtained, they would proceed to reporting. If it's not obtained, then they would actually suggest that additional audit procedures be performed. And lastly, we talked about the reporting, that there are various types of report, including the unmodified, qualified, adverse, and there is a disclaimer of opinion. The next step that we discussed was the audit planning, and in the audit planning what we did discuss was that the audit planning has got various steps, and the key step of the audit planning is you plan out the resources that you would be needing during the course of the audit, whether that be with respect to the staff, whether that be with respect to the experts, and etc. etc. Then we talked about understanding of the entity, where we discussed that what do you need to understand, the business structure, the operating cycle, the supply chain, etc. We talked about understanding of the entity's environment, and the environment was actually the external and the internal environment both. So we talked about it, that the external environment would actually have a relationship with the entity's financials, and the internal environment would also have a relationship with the entity's financials. Then we moved on to the assessment of the risk of material misstatement. And the risk of material misstatement, I talked about materiality. I discussed that materiality is when you have got a specific threshold being met, that is what is considered to be materiality. And then there is a risk of material misstatement. So the misstatement is either of that the non-compliance with the accounting framework is there, or maybe there is a non-validity of the assertions. So we talked about the assertions, that what are the various assertions. So we did discuss them. Then we started attempting one of the questions. So after we did that question, we actually attempted only one part of the question. We now need to actually move on to the second part of the question. The question was question actually March, June 2017, question number 1. We did discuss part A of the question. What I'm going to do is that I'm going to take a short break for the namaz, which is going to be a 10-minute break for the Maghrib prayers. So you can offer your Maghrib prayers, and then we can start off at 6:20 p.m. So we would continue with this section D area of the syllabus today again, and hopefully that we're gonna cover a lot of things pertaining to it. So for those of you who wanted me to share you this file, I'm gonna share at the end of the session today. I'll ask my guy to actually put it in the handout section. Okay, welcome back everybody. Now, so we are going to resume where we left yesterday. So if you are going to come on to this question of March, June 2017, the question had three requirements. One of them was basically evaluate the risk of material misstatement to be considered in planning the group audit. Your evaluation should utilize the analytical as a method for identifying risk. We did that yesterday. And we did actually have an analysis of how the marks are being granted in this question also. So we did the entire of this question. Now what we need to do is that we now need to move forward and we now need to discuss further. So now next situation is basically it says recommend any additional information which should be requested from the group, which would allow a more detailed preliminary analytical review. So what they want is, they want you to identify that any additional information which should be requested from the group, which would allow a more detailed preliminary analytical review. Now, one thing is, we did perform the analytical procedures yesterday, but what the examiner is asking is that you need to recommend any additional information. Now, first of all, there are few things to this question. Number one of them is recommend. So now, whenever the examiner talks about recommending, so while he is talking about recommend, so recommend does not actually mean that you suggest. In fact, you suggest and you justify. You suggest and you justify why are you suggesting it. So recommendation is not just about stating or listing down the things. What they want is they want you to justify every single recommendation that you make. Whatever that you suggest, you need to justify why you're suggesting it. So one thing is, if somebody is involved in just listing down that what additional information should be requested, they're just going to give maximum 2 marks if you do it. You're going to get only 5 marks if you actually explain them also. So recommend any additional information. Now, if I just have a look at this financial statement, so I would get an idea that property, plant, equipment, it actually gives you 9278. If you could recall from yesterday's class that the property, plant, equipment in this question, actually there were 2 changes. One of them was there was a capital expenditure of 20 million. And in addition to the capital expenditure, there was a reduction in the depreciation. So in order to have a better analytical procedure, I would actually suggest that we should actually seek the additional information which is part of part B of the question. Part B, additional information. So when we talk about part B, which is about the additional information, so what are we going to suggest to the examiner? We are going to suggest to the examiner that you should seek the property, plant, equipment breakup to compare their movements because of depreciation during the year. Then in addition to this, if we talk about it furthermore, if you're going to see, you'll find intangibles. There is this goodwill, acquired brand names, development cost, then the total non-current asset, and then there are current assets. So they should give a detailed current assets breakdown. So current assets breakdown is important. So we can perform a detailed analysis on various items like inventory, holding period, and at the same time, in addition, inventory holding period and the receivable collection period, etc. The third one of them is, this is the current asset. Then the third one of them is equity, share capital, retained earning, NCI. So the third one of them is maybe the current liability. The breakup of current liability would also be ideally important. Breakup of current liabilities. You see the current liabilities. The current liabilities have actually gone down. If you see, the current liabilities have gone down, so we need to analyze the reason for reduction in current liabilities. Furthermore, there is this revenue and then there is this operating expenses. So a better would be that a breakup of that cost of goods sold be presented, so we can have an idea that what is the trading profit. We can have an idea what is the trading profit and what is the proportion of expenses incurred for other purposes. So you see, we need to have an idea about what to do. So basically the question's requirement was, it was requesting you that what additional information would be needed. So what additional information would be needed? So we have actually discussed that what additional information would be needed. So the additional information for your preliminary analytical review that is actually going to be needed is going to be that you need to advise that what are going to be the additional source of information that could help you perform a better analysis. So that's what you need to do. Now let's move forward, and it says recommend the principal audit procedures to be performed on the impairment of Chico brand and planned acquisition of Azalea company. Now there is something very important, and that important thing is that at times the students, when the questions requirement comes in that you have to perform the principal audit procedures that you need to perform. So students at times they focus upon rectifying, they focus upon actually remembering or rote learning these things. So what is important is that you should not actually try to rote learn these various audit procedures, and instead try to understand the methodology behind the audit procedures. So the next requirement, which is part C, the part C requirement is actually where the examiner is asking you, detailed audit procedures. Examiner is asking you detailed audit procedures. Now, first of all, you need to understand that what exactly is an audit procedures. So whenever we do talk about the audit procedures are actually covered up by AISA 500 series. So AISA 500 series actually covers up the audit procedure. So whenever we do talk about the audit procedures, so in general, whenever we do talk about the audit procedure, our main focus is that why do we perform the audit procedures? We perform the audit procedure because we want to gather the sufficient and appropriate audit evidence. So we perform them because we want to gather sufficient and appropriate audit evidence. So question mark is, why do we perform the audit procedures? We perform the audit procedures because we want to gather sufficient and appropriate audit evidence. Now, what's a sufficient and what's an appropriate audit evidence? So let's just have a quick discussion about it. Whenever we do talk about the sufficient appropriate audit evidence, sufficiency actually refers to the quantity of the evidence that you have gathered. Quantity of evidence that you have gathered, that is sufficiency. And when we talk about the appropriateness, so appropriateness actually means relevant and reliable. Relevant and reliable. So whenever you've got the audit evidence which is relevant and at the same time which is reliable, that means that is an appropriate audit evidence. So as an auditor, your objective is you need to gather sufficient and appropriate audit evidence. As an auditor, you need to gather sufficient and appropriate audit evidence. Now, if I talk about the sufficiency of audit evidence, the sufficiency of the evidence is basically the quantity of the evidence. So that is actually the quantity of the evidence. Now, and appropriateness means relevant and reliable. Appropriateness means relevant and reliable. So let's just have a quick discussion about all this. So if I talk about the quantity of the evidence, so generally what happens is there is this AISA 530, which is actually about the audit sampling. So when we apply AISA 530, AISA 530 actually guides you that how to draw the samples, because you see we perform the audit on a test basis. We don't perform the audit on 100% basis, we perform it on a test basis. So if we perform it on a test basis, so what we need to do from the AISA 530 perspective is that we need to actually the audit sampling, the AISA 530 audit sampling, it actually gives us the guidance about the various techniques which could be used to draw samples. Various techniques that can be used to draw the samples, that is important. So ISA 530 actually guides you about the various techniques that could be used to draw the samples, number one. Number two, when we talk about the relevant and reliable audit evidence, so relevant and reliable audit evidence actually means the audit evidence is relevant when it is satisfying a relevant assertion. And audit evidence is relevant when it is satisfying a relevant assertion. For example, if you want to verify the accuracy, of a transaction, so accuracy of the transaction which is actually being undertaken. So accuracy of the transaction, a better evidence would be that you might inspect the invoice, you might inspect the bank statement for the payment, or etc. So that is what is going to be considered as an accuracy. So basically when we talk about the relevance and the reliability, so relevant is satisfying a relevant assertion. Accuracy basically that's what it is. So accuracy of the transaction needs to be verified. So you might actually go for invoice or the bank statement or etc. And when we talk about the reliability, so reliability is basically generally refers to the quality. And an audit evidence in accordance with ISA 500 is more reliable when it has got certain characteristics. And what are those characteristics? Number one of them is it is auditor generated. Number two is strong internal controls. Number three is original documents. Number fourth is it is in the written form. And the fifth one is that externally confirmed. So if we talk about the reliability of the audit evidence, so what we can actually talk about is that the audit evidence has more reliability when it fulfills these five characteristics, that this is being generated or gathered by the auditor himself, number one. There are strong internal controls which are prevalent in the organization. The third one of them is there is an original documents. There are original documents. The number fourth one of them is basically that the evidence is in the written form. And lastly, the evidence has been externally confirmed by external party. So that makes the evidence more reliable. So these are the various characteristics which make evidence to be reliable. So when we talk about our requirement of audit procedures, so first of all, the audit procedures are actually the actions that an auditor performs. What are the audit procedures? The audit procedures are the actions that an auditor performs to verify if the audit risk exists. So actions that an auditor performs to verify if the audit risk exists. And what is the objective of performing the audit procedure? The ISA 500 series, it requires that the auditor has to try and gather sufficient and appropriate audit evidence. And what's the sufficient evidence? What's the appropriate evidence? So we have actually talked about the sufficiency and appropriateness of the audit evidence. Now, how to actually make audit procedures? So when we talk about making the audit procedures, so first of all, you need to understand that the audit procedure actually arises from the audit risk or the risk of material misstatement. So what exactly is the audit risk or the risk of material misstatement? A very simple approach of identifying the audit risk or the risk of material misstatement is actually you need to think what could go wrong. So if I talk about that, what exactly is a way of identifying that for making the audit procedures is to first of all identify the risk. So when you talk about identifying the risk, you think about what could go wrong with financial statement. And then in addition to this, the audit procedures are actions are actions performed by the auditor to check if something gone wrong. So what you need to do is that you need to think what could go wrong with financial statement. And once you basically have thought that what could go wrong with financial statement, then the procedures will actually guide you that has something seriously wrong with the financials. So generally speaking, when we talk about the audit procedures are generally AEI square. I am unable to make this square sign. You understand this square? It's basically square O and U. So what exactly is it? It is analytical procedures. Then there is this external confirmation. Then there is this inquiry, the inspection, the observation, recalculation, and reperformance. So these are the various audit procedures that can be performed. So basically, I'm going to give you a brief guidance as to, first of all, you need to have the risk in mind. Till the time you don't have the risk in mind, you can't perform the procedure. Example is that if we look at this question, it says the impairment of the Chico brand. Now, you need to think what are the risks with the impairment of the Chico brand. So one of the risks is that impairment loss recognized in OCI. Now, you need to think what could go wrong. You need to think what could go wrong. So I am saying that one of the risks is that the impairment loss is recognized in the other comprehensive income. So my procedure to this is going to be that I'm going to check whether the gain or loss has been recognized in the OCI or in the P&L. So my procedure is basically trace recognition of impairment loss to profit and loss account to confirm that it has been recognized in P&L. So you see, the risk was impairment loss recognized in other comprehensive income. The procedure is trace the recognition of impairment loss to P&L to confirm that it has been recognized in P&L. So basically, this is how you actually perform the audit procedure. So now you don't need to remember a huge list. All that you need to do is that you just need to think what could go wrong, which is identify the risk. And then at the same time, once you've identified the risk, so what you could do is that you could just actually perform the procedure to check if something has actually gone wrong or not. So that's what the audit procedure is. There is somebody who's asking for a question about okay, audit procedures are actually the actions that an auditor performs in order to check if something has gone wrong or not. So the actions that an auditor performs in order to see if something has gone wrong or not. So that's what the audit procedures are. So it's time now that you people do the audit procedures onto these things. So part C of the question March, June 2017, you need to now actually go. Yes, Mahmood, the auditor might actually go wrong. That's why there is a review stage. Anyways, let's just take 5 minutes and try to attempt it. Okay. So if we talk about the impairment, the uh, audit procedures that need to be performed, number one thing is both the requirements are of 5 marks each. This actually goes to show that you need to write 5 points to each of it. So you need to write 5 points to each of it. That's what the requirement actually indicates. Now, first of all, if I talk about this acquired brand names, in fact the impairment of the Chico brand name. So it says the acquired brand names were held at cost and not amortized on the ground that the assets have indefinite life. Annual impairment reviews were conducted on all brand names. In December 2016, Chico brand name was determined to be impaired due to allegations made in the press and customers that some ingredients could be used in the perfume range, etc., etc. Now see, number one. When we talk about this impairment of brand name, so first of all, you need to think about the various risks. You need to think about the various risks. Now, if I say that if I need to think about the various risks that are involved, so I'm going to actually talk about the various risks. Number one of them is you need to understand what does impairment involve. Impairment is whenever the carrying amount of an asset is greater than its recoverable amount. And the recoverable amount is higher of fair value less cost to sell and value in use. The recoverable amount is the higher of fair value less cost to sell and the value in use. Now, if I go further, so I say the impairment of brand name, impairment is when the carrying amount of the asset is recoverable, carrying amount is greater than the recoverable amount, and recoverable amount is the higher of fair value less cost to sell or the value in use. Now, the fair value less cost to sell is something that everybody does understand, that fair value less cost to sell is you calculate the fair value of the asset minus the selling cost. And the value in use, what exactly is the value in use? So when we talk about the value in use, so value in use is the present value of future cash flows. Present value of future cash flows from continuing use of asset. And from its ultimate disposal. So now you see, you need to, whenever the risk arises, you need to think what could go wrong. Now, if I actually just list down the various risks, so number one of the risk is basically the fair value is incorrect. Number two, the future cash flows are incorrect. In fact, the broader risk is value in use is incorrect, and the value in use is incorrect because the future cash flows are not reliably estimated. Number one. At the same time, the discount rate is not appropriate. There is a further risk, and that further risk is that the impairment loss is recognized in profit and loss account. So the first one of them is the fair value is incorrect. The number one of them is the value in use is incorrect, and the value is incorrect because future cash flows are not reliably estimated, or the value in use is incorrect because the discount rate is not appropriate. The impairment loss is recognized in other comprehensive income instead of the P&L. The further risk is that these are the various risks that are there. So useful life is not estimated. So if I talk about it, now what are going to be the procedures that I'm going to perform? The procedures that I'm going to perform in order to verify that. So the number one of them, the risk is the fair value is incorrect. So I'm going to say inspect the valuer's report of the valuer's report to confirm that fair value used in impairment calculation is accurate. Now, there could be another procedure that could arise from this is that you see, when you use a valuer is an expert. So basically what happens is you can actually, there is this ISA which is ISA 620, and it requires that while using the work of expert, you need to perform the several tests on the expert, which is the CCI test. The CCI test actually means the competency, the capability, and independence. So you could perform a CCI test on the expert. So your procedure could actually be test the valuer for competency, capability, and independence. That could be one of the audit procedures. Now, in addition to this, test valuer's report for the CCI. In addition to this, if I do talk about it, then there is going to be that test the assumptions used by valuer for reasonableness. So you've got various procedures, and what the various procedures are, that we are actually trying to ensure that the risk does not exist. So basically the audit procedure is derived from the risk, and for the risk you need to think what could go wrong, and then the audit procedure comes in. Now, value in use is incorrect. So now what are we going to do when it comes to value in use being incorrect? So what you could do is you could say that for the value in use to be incorrect, obtain management written representation to confirm that cash flow estimates are reliable. Test assumptions used for cash flow forecast for reasonableness. The discount rate is not appropriate, so you might actually check that if the discount rate is not appropriate, then you will you would verify that assess how management determined the discount rate and test such test such assessment for reasonableness. Then there is this impairment loss recognized in P&L and the useful life not estimated. So basically these are the various audit procedures that you're going to perform on this. So my point is that the audit procedures are something which are a very easy job, which are a very easy task, as long as you understand that why exactly are we performing the procedures. So we are performing the procedures because we want to actually see if we are performing the procedures because we want to see if something has gone wrong with the financial statements or not. So first of all, you need to think what could go wrong with financials, and then you test them. So automatically you have got the audit procedures. Now, there's this planned acquisition of AAA company. Now it says group is currently negotiating the acquisition of AAA company, a large company which develops and sells a range of fine fragrances. Now it is planned that the acquisition will take place in early June 2017. It is planned that the acquisition will take place in early June 2017. And the group is hopeful that AAA company's products will replace the revenue stream lost from the withdrawal of its Chico perfume range. So it is expected to take place in June 27. Due diligence is taking place currently, and the group's management is hopeful that this will support the consideration of 130 million offered for 100% of Azalea's share capital. Group's Ben has agreed to provide a loan for this amount. Now, we are preparing financial statement for 31st May 2017. So if we are preparing company's financial statements for the 31st May 2017, what we need to do is that we need to actually consider that what are going to be the risks with respect to the planned acquisition of this Azalia company. So there are certain things. Number one, the management is negotiating acquisition of Azalia, a large company which develops and sells a range of fine fragrances. Now it is planned that acquisition will take place in June 2017, and the group is hopeful. And the group is hopeful that the products will replace the revenue streams lost from the withdrawal. So basically, if it take place in June 2017, that means this is an event after reporting period. This is an event after reporting period. Okay, so now first of all, it's gonna be event after reporting period, and it is gonna be a non-adjusting event after reporting period. Does take place, then you need to disclose the details with respect to this acquisition. You discuss the disclosure with respect to this acquisition, number one. Number two, so basically the negotiations with the bank are going on. So what is going to happen is that if there are negotiations that are taking place with the bank, so what does this would actually show? This would actually tell you that whether the bank is going to be approving the loan or not, and under what terms and conditions. So you might actually inspect the negotiations with the bank. Then there is another risk which is with respect to the valuation. So you might actually need to see the due diligence report. Calculation of goodwill could actually be an issue. Recognition of loan in financial statements. So the various risks that could actually arise with that, the disclosure with respect to this acquisition is not given in accordance with IAS 10. The negotiations with the bank might not fall through, and ultimately the loan might not be negotiated, or if it's negotiated, it might be negotiated different rate or different terms. The valuation report would actually tell you that whether the correct valuation has been placed or not, whether the goodwill has been correctly calculated or not. And then there is the recognition of loan and financial statement in accordance with IAS 30 with IFRS 9. So these are the various risks that you actually might come across when you have to perform the audit procedure. So basically, if the questions requirement is actually about the audit procedure, then That means you need to actually think and you need to actually see what could go wrong, and once you have identified the risk, then automatically you could perform the procedures for those risks. So we're done with this question. It's a 16 plus 15, a 31 mark question that we have actually done, and we have gone through this question and we have tried to actually prepare that how the answer should be given to this question. So what I'm going to do is that I'm now going to move on to the next question, and I'm going to discuss further that how the things should actually be considered in the various scenarios. So the next question that I'm going to go through is December 2016. The next question that I'm going to go through is December 2016. So December 2016, and it says that December 2016 question number 1. So the next one of them is December 2016 question 1. It says the Z Communication Group is an audit client of your firm Tarantino & Co. With a financial year ending 31st December 2016, you're a manager assigned to so-and-so, so-and-so. Requirement is evaluate the audit risk to be considered in planning the final audit of ZCG. Number B, it says discuss the matters to be considered in determining the assistance which could be provided by and the amount of reliance, if any, could be placed on the work of internal audit department. Number C, recommend principal audit procedures to be performed, so and so, so and so. So now you try and attempt this question December 2016, question number 1. You attempt the part A of this question, then you're going to discuss. Yes, the audit evidence should actually meet that. So please take 10 minutes and try to attempt this. Okay, so I think you have had sufficient time to actually go through this question. Now let's just have a quick discussion on this December 2016 question number 1. The question's requirement is actually, if we go through this question, it says the Z Communication Group is an audit client of your firm, the Tarantino and Co. with a financial year ending 31st December 2016. You are the manager assigned to the forthcoming audit. ZCG is a listed entity. So remember, it's a listed entity. One of the largest telecom providers in the country and is seeking to expand internationally. So it's seeking to expand internationally, meaning that there's going to be foreign currency involved. ZCG also provides broadband and fixed telephone line services. Now, you have just received the following email from the audit engagement partner, and what does he say? He says that we need to begin the final audit of ZCG, which, as you know, is one of our largest audit clients. I met with Group's finance director yesterday, and I provided you with the notes from this meeting along with extracts from latest management accounts. We've also discussed possibility of using Group's internal audit team to improve audit efficiency. I provided you with an extract from latest report from the internal audit department. Now, using all the information provided, you are required to prepare briefing notes for my use, in which you, number 1, evaluate the audit risk relevant to the planning in the final audit of the ZCG. So whenever we do actually talk about the audit risk generally refers to the risk that the auditor expresses an incorrect audit opinion. Why would an auditor express an incorrect audit opinion? The audit risk is actually a makeup of inherent risk into the control risk and into the detection risk. So the auditor risk is actually a makeup of inherent risk, control risk, and the detection risk. And the inherent risk and the control risk, are also termed as risk of material misstatement. So the audit risk is simply risk of material misstatement multiplied by the detection risk. So how would we actually identify the audit risk? The same way we identified the risk of material misstatement, which is you need to think what could go wrong. You need to think what could go wrong with financial statements. So you need to think what could go wrong with financial statement. That's what the audit risk is all about. Now, so you need to say that evaluate the audit risk relevant to the planning of the final audit of ZCG. Furthermore, it says discuss the matters to be considered in determining the assistance, etc. Now, first of all, one of the ZCG's strategic aim is to expand internationally, either by acquiring existing telecom providers in other countries or by purchasing licenses to operate in foreign countries. March 2016, ZCG purchased a 50% shareholding in Wallace Telecoms, a company operating in several countries where ZCG had no interest. The other 50% is held by Wolf Communications. The cost of 50% holding was $45 million. ZCG is planning to account for its investment as a joint venture in the group financial statements. Now, first of all, let's just try to understand this thing, that it is planning to classify it as a joint venture in financial statements. So what's a joint venture? A joint venture is an entity subject to joint control. An entity which is subject to joint control is called a joint venture. So what's a joint venture? A joint venture is an entity which is subject to the joint control. So that's actually termed as a joint venture. Now, whenever we do talk about it, so basically, how do we account for a joint venture? A joint venture is accounted for using equity method of. Number one of the risk is that this entity meet the definition of a JV. This entity does not meet the definition of a JV. That is, the entity does not meet the definition of a joint venture. That's one of the risks. Number two, if it does meet, then entity is not properly accounted for under IAS 28 investment in associates and joint venture. So number one of them is basically the accounting for a joint venture, because the first of all is classification of joint venture is very technical. I mean, there is a very thin line between an associate and a joint control and a control, because you need quite a lot of at times judgment to establish if there is a joint control or if there is a control or if there's just an associate. So that is one of the things. Number two, it says in January 2015, ZCG purchased a license to operate in Farland, a rapidly expanding economy, at a cost of 65 million. The license lasts for 10 years. The license lasts for 10 years from the date it was purchased. And since purchasing the license, ZCG has established its network coverage in Farland, and the network became operational on 1st July 2016. Which year end are we talking about? We are talking about the year end of 31st December 2016. So what has happened is they have purchased the license on 1st January at a cost of 65 million. The license became operational so and so, so and so. License was recognized as intangible at cost in the group financial statements. Since network became operational, customer demand has been less than anticipated due to competitor offering a special deal to its existing customers to encourage them not to change the providers. Now you see, understand this thing. Now what are the risks involved with this next area? So the risk involved is, number one of them is that the license is not amortized license is not amortized. That's one of the risks. The second thing is that it says that the competitor has there's one more risk. The license is not amortized, and one more thing that IAS 16 also says and the IAS 38 also says, which is that the depreciation or the amortization shall commence on the date the asset is available for use. So there is actually a risk that the amortization is recognized from 1st July instead of 1st January. License is not amortized, that's one of the risks. So the various risks are license is not amortized. Number two is that amortization is recognized from 1st July instead of 1st January. Number three is that the competitor has, what has happened is the competitor has actually offered a special deal to encourage the customer not to change the providers. So the competitor has taken action to retain its customers. So if it has taken the action to retain its customers, then what would happen is that there is a indication of impairment. You would say why? Because the revenues Now, the next one of them is most of the ZCG's mobile phone customers. I would like to highlight one thing. Recently, the last attempt, the examiner has mentioned the comment about the need for students to stay updated. Now, what do we mean by need for the students to stay updated? The need for the students to stay updated is basically the new accounting standard of IFRS 15 is being introduced, and the students, they are actually generally unaware of IFRS 15. And they keep referring to IAS 11 and IAS 18. So the examiner actually gets a hint, gets an idea that you're not updated, and he does not actually get very pleased with it. So it's better that if you don't actually mention about the standard, or if you do mention, then ensure that you mention about the correct standard. So it says ZCG's mobile phone customers sign a contract under which they pay a fixed amount each month to use ZCG's mobile network, paying extra if they exceed the agreed data usage and year limits. Contract also allows connection to fixed line and internet access using broadband, and most contracts run for 2 or 3 years. For the first time this year, the group is adopting IFRS 15, the revenue from contracts with customer. So basically now what happens is the IFRS 15, it requires that it discusses about the concept of a contract assets. Contract assets are the costs incurred in order to enter into a contract and are expected to provide benefits for a period of more than 1 year. So basically what happens is, over here, what is the risk? The risk is that the cost incurred to obtain contract have not been capitalized and instead expensed out. Next, in order to extend its broadband services, ZCG has started to purchase network capacity from third-party companies. ZCG enters a fixed sum contract to use a specified amount of the seller's network capacity, with the seller determining which of its network assets are used by ZCG in supplying network services to its customer. In the first 6 months of the 2016, ZCG purchased 17.8 million of network capacity from a range of suppliers, with the contract periods varying from 12 months to 3 years. The cost has been capitalized as an intangible asset. Now, one thing is basically there is a new accounting standard which is IFRS 16 leases. If I talk about IFRS 16 leases actually discusses that the accounting for lessee has changed. The accounting for lessee has changed, and the revised accounting now requires lessee to account for the assets under the lease on a right of use, which is ROU basis. So now see, basically what happens is, how do we record it? We record it this way, like right of use of the asset, debit, and correspondingly credit. So basically all the assets, all the contracts under for the use of network capacity shall be recognized under IFRS 16 using ROU accounting. For contracts of less than 1 year or a smaller value, the ROU shall not be recognized, and instead the rentals shall be recognized as expense in profit and loss account. So basically, what are the risks involved? The risk is basically that entity has not recognized ROU in accordance with IFRS 16. Then ROU is not subsequently depreciated, less than 12 months contract are capitalized, less than or up to or less than 12 months contract are capitalized. So these are the various risks that are involved here. So you need to consider that what are going to be the various risks that are going to be involved. Now next. I'm not going to discuss the internal audit section right now. There is this financial information that extracts from the latest management accounts. It says that 8 months to 31st August 2016, audited financial statement 31st December 2015. You could see from the audited account Europe, America, Southeast Asia, India. These are the various regions in which the entity is operating. And at the same time, the total assets are so and so, so and so. If you see that the revenues are actually going down, whereas the assets are going up, the revenues are going down and the assets are going up, especially this, there's a significant decline in Americas. That means that the assets in Americas are actually going to be indication of impairment. So risk is that impairment assets of Americas are not tested for impairment. And what else? Is there any other risk? Yes. Basically, IFRS 8 operating segments. It applies to all the entities who are either listed or in the process of being listed. All those entities who are listed or either in the process of getting listed, they have to apply IFRS 8 operating segment. So they have to give a disclosure based on operating segments. And here it could be seen that they've got a geographical presence. So what they should do is that they should give a geographical, they should give a disclosure as per IFRS 8. And the risk is that it might not have been done. So these are the various risks which you could identify from the given scenario. Danish, I can't actually go through the complete standard right now. You could go to the ACCA's website and you could go through this IFRS 16. Okay, so now that is actually part A. That is one requirement to the question. What we are going to do now is that we are going to take a short break of 10 minutes and we're going to start again in 10 minutes time. You can relax, you can actually relax a bit during that time and then we are going to start again. Okay, so welcome back. Now we were actually on to this section that we actually ignored, and that was the internal audit. So let's just go through this area and audit department, which is tasked with a range of activities, including providing assurance to management over. That's what the internal audit department is currently being tasked with, which is actually providing assurance to management over internal controls and assisting the group's risk management team. Now, internal audit department is managed by Jules Winfield, a qualified accountant with many years of experience. An extract from executive summary to the group finance director is shown below. It says that we are pleased to report that ZCG's internal controls are working well, and there have been no significant changes to systems and controls during the year. As a result of our testing of controls, we uncovered only 2 financial irregularities, which related to failure to obtain appropriate authorization and approval of senior management expense claims such as travel and other. The unsubstantiated expense claims amounted to 575. Inadequate access over the control of the group's IT systems. This resulted in payroll fraud of 750,000. Now, one more audit risk that you could identify are the weak internal controls. One more audit risk that you could identify are the weak internal controls. So the weak internal controls are also one of the audit risks that we need to actually highlight in this specific scenario. So because you see that there have been frauds, there have been frauds during the year, and the frauds are of 575,000 plus 750,000. You could compare the total. You could actually total both of this 570 and 750,000 and compare it with the total amount of this. You could compare this 550,000 plus 750,000 with the total profit before tax and see the level of materiality. So you could have an idea if it's a material misstatement or not. Then, so basically that's also one of the things. Now, the next requirement of the question is discuss the matters to be considered in determining the assistance which could be provided by and the amount of reliance, if any, which can be placed on the work of ZCG's internal audit department. So now let's just talk about it one by one. It says discuss the matters to be considered in determining the assistance which could be provided by and the amount of reliance, if any, which can be placed on the work of ZCG's internal audit department. Now, if I discuss this specific area, so there is this ISA, which is ISA 610, and that is actually about the reliance on the work of internal auditors. So generally what happens is when we talk about reliance on the work of internal auditor, so how do we actually determine whether we should place a reliance on the work of internal auditor? So then again, just like we perform the CCI test on the expert, the same way we perform a sort of CCI test on the internal audit department, which is actually about the competency, number one. Apparently, this seems to be a competent department because the head of internal audit is a qualified accountant with many years of experience. The independence might actually be a question mark because what happens is they are reporting to the finance director. Now that's a question mark. If you are reporting to the group finance director, that's an inappropriate reporting. I mean, you should rather be reporting to the audit committee. You should not be reporting to the finance director. So apparently there seems to be something wrong with the way they are actually reporting. And then again, at the same time, if we talk about that the system of internal controls which are operating within this organization, so apparently what happens is there is a control weakness. There's a control weakness, and the control weakness has resulted in 2 frauds during the year. So frauds during the year. Now what happens is the questions requirement is Discuss the matters which need to be considered in determining the assistance which could be provided by and the amount of reliance, if any, which can be placed in the work of internal audit department. So apparently the department is qualified, etc. But then again, there are control weaknesses. The department's independence is in doubt. Now, it says, as a result of our testing of controls, we uncovered 2 financial irregularities which related to failure to obtain authorization and so and so. I mean, if you read this part, it says we are pleased to report that ZCG's internal controls are working well, and there have been no significant changes to the controls during the year. Now you see, you have figured out a fraud, you have figured out a problem, and then again you are saying that the internal controls are working well. See, there is a misstatement. You have identified this misstatement. How could you say that the internal controls are operating correctly? And how could you be just so comfortable with these internal controls? So there is a serious issue with this. So the independence, or maybe the capability of the internal audit department, because it's a very judgmental thing. Even a fraud, if it is being committed within the organization, that needs to be highlighted, that needs to be identified. So why is it the case that you have not identified the fraud? I mean, why is it the case that you have not actually updated the internal control procedures? So these are the various factors that you're going to consider and you're going to cover. Now, let's move forward and let's just discuss further. So this is something that you are going to do. So you're going to say that, okay, you could place reliance on the work of internal auditor by considering the various things, whether the internal audit department is complying with these things or not. And at the same time, now these things, which is that the fraud were detected and they're taking it too lightly and they're like, okay, this happens, etc. This is not something that is good for the organization, for the entity. The next requirement to this question is basically you need to recommend the principal audit procedures. You need to recommend the principal audit procedures that are to be performed on the classification of the 50% equity holding in WTC as a joint venture and the measurement of intangible asset recognized in respect of license to operate in far land. So now if I do discuss this, what I'm going to do is that I'm going to talk about, I'm going to tell you that the audit procedures are performed in the same manner. That first of all, you need to identify the audit risk. Once you've identified the risk, that what could go wrong, then what can happen is that you could actually test if something has gone wrong or not. You could test if something has gone wrong or not. So now see, over here in this case, if we talk about number one of them is actually the classification. Now, see, the question does not tell you that this is a very important point. The procedures are to be performed on classification of a 50% equity holding. Classification of 50% shareholding as a joint venture. So joint venture means joint control. So you need to perform the procedure which could actually tell you whether is there a joint control or not. So remember, you don't have to perform the procedure on measuring this joint venture. You have to perform the procedure on the classification area only. So the 4 mark is just about classification. Now, if I'm in an exam question, how am I going to decide that how am I going to decide that what should be the procedures for the classification? So you need to plan out that it's just the classification, it's nothing else. Now, if I say classification, what makes an entity to be a joint venture? An entity to be a joint venture means joint control. Okay, what is the joint control? Joint control is none of the party can decide single-handedly. That means for everything there has to be a mutual consent. That means for everything there has to be a mutual consent. Now, for everything, if there has to be a mutual consent, so you need to think that how would you, you need to see that are there mutual consents. Now, what are going to be the things which would actually help you? Now, see, number one of them is a pattern of shareholding. Pattern of shareholding that would actually help you identify that whether there is a joint control or not, number one. At the same time, BOD representation, BOD minutes, BOD minutes. So the classification is the pattern of shareholding. That what is the pattern of the shareholding? The board of director representation, are they being equally represented by both the companies? The BOD minutes could be inspected to see if the mutual consents have been obtained or not. So these are the few things that you could actually do in order to establish if there is a joint control or not. Number one. Number two. Number two is about the measurement of intangible recognized in respect of the license. So if I talk about measurement of intangible, so what are the various risks that are there with respect to the measurement of intangible? The various risks with respect to the measurement of intangibles would actually include number one, the cost. Number two is the life. Number three is the amortization. So it's actually about the cost, the life. It's actually about the cost. It's actually about the life. It's actually about the amortization, and also about the impairment testing. So now, what could be the procedure? The cost could be incorrect. Now, what am I going to do in order to check if the cost is correct or not? So I would inspect the purchase agreement. What else am I going to do? I'm going to inspect the purchase agreement. I'm going to, at the same time, trace payment to the bank statement. Okay. The term of the license from the license agreement. There's going to be a recalculation of amortization. Impairment testing. Apparently there are no indications. In fact, no. Just hold on, wait. Yeah, impairment indication. The value in use calculation needs to be inspected, and the fair value less cost to sell also. So there are impairment. So basically, if we talk about the measurement of the intangibles, so these are the various things that you would do, that whether the cost has been correctly calculated by inspecting purchase agreement, tracing the payment to bank statement. You need to see if the life, which is the term of the license, amortization, the impairment testing, etc., etc. So I hope this actually is clear to everybody, and nobody has questions relating to it. If anyone has any questions, please do ask, and then I can actually move forward. Yeah, if there is anybody who has any question, please do ask, or else I'm going to move forward to the next area of the syllabus. Abrar, which audit procedure are you talking about? Smita, you don't need to mention the full either and the answers. Farasat, I think this is sufficient enough explanation, because what I'm trying to do is that I'm trying to see the marks available for a question and I'm trying to write the points. Adim, easy way to write the audit procedure is simply you need to think what could go wrong, and then you need to actually check whether something has gone wrong or not. Abrar, yes, pattern of shareholding is a audit procedure, because what you're going to do is that you're going to see the pattern of the shareholding, so that you can inspect the pattern of the shareholding so that you have an idea that who has how much shareholding. Yes, this would be shared at the end of the session. Adim, no, not necessary to reference the IDA. Deepika, I mean, it's not 100% worded answers, but I'm gonna actually go ahead with it also. I mean, writing down the whole answer, but I'm just trying to actually guide you that this is actually one of the ways. I mean, these are the various things that you identify. So I've not written it in a complete manner that how the audit procedure is drafted, but I have at least given you an idea that what exactly you need to do in this scenario. Farasat, we could not share it yesterday. We'll do it today. Okay, so now guys, we are now moving on to the next area of the syllabus. So if I talk about the next area of this syllabus is basically we have gone through the audit planning stage. We have actually planned out the audit, and we do have an idea that what does an overall audit planning involve. So we have actually planned out this audit. Now the next step is the performance stage of the audit and the finalization. So we have even discussed that what happens at the performance stage of the audit. You try to gather the audit procedure. Sufficient and appropriate audit evidence needs to be obtained, so you try to do that. Now number 5 is finalization of the audit. So now the next area of the syllabus is the finalization stage of the audit. So I'm going to discuss that what exactly happens at the finalization stage of the audit. Okay, now let's just try to understand that what happens at the finalization stage of the audit. Let's just try to understand that what happens at the finalization stage of the audit. Usually after the planning stage, there is this performing stage. So once the audit has been performed, then the working papers are ready. And these working papers are presented to the senior manager or the manager, and what he does is that he reviews the working paper to check if sufficient and appropriate audit evidence is obtained. If it's yes, then he goes for the reporting. If yes, then he goes for reporting. And if no, then what happens is he go for additional audit procedures. He would recommend you to go for additional audit procedures. Now, a typical exam question of the finalization or the review stage is basically you come across a requirement which is the questions requirement is comment on the matters. Generally speaking, the question requirement that comes in for this specific stage of the audit is that comment on the matters to be considered. It says comment on the matters to be considered and state the audit evidence that you would expect to find in your review of the audit working papers. Now, if I talk about it, comment on the matters to be considered is one area of the requirement. Then there is this state the audit evidence that you would expect to find in your review of the audit working paper. That is another area. Now, if I do discuss these areas, that what exactly do we write in these areas? So the number one of them is whenever the questions requirement says comment on matters to be considered. So generally the examiner's suggestions, the examiner direction or the examiner's guidance with respect to this area is you need to talk about, you need to discuss or you need to calculate materiality. Number one, you need to calculate the materiality. That's the number one thing that you need to do. And once you have calculated the materiality, so after the calculation of materiality, you need to actually discuss the accounting treatment. And once you have discussed the accounting treatment, you have to discuss the risks involved. You have to discuss the risk involved. So this is what happens in comment on the matters to be considered. So whenever the questions requirement comes across, that comment on matters to be considered. So what are we going to comment on the matters? We're going to discuss the materiality. We're going to discuss the accounting treatment, and we will discuss the risk involved. So one of them is comment on the matters to be considered. And the second one of them is audit evidence. Audit evidence. Now there was a question, there was a student who did ask that what exactly is the difference between the audit evidence and the audit procedure. So let me discuss that procedure is an action. Procedure is an action. The evidence is the result of an action. Procedure is an action and evidence is the result of an action. So meaning what happens is if we inspect valuer's report, that's a procedure. Now we find valuer's report in working papers, that's an evidence. So when we talk about the procedures are the actions that you perform. And the evidence is the result of an action. The result of an action is basically, if we say inspect valuer's report, that's a procedure. If we say evidence, so the evidence we would expect to find is the valuer's report in the working papers. So basically if the questions requirement comes in that comment on the matters to be considered and state the audit evidence, this is how you're going to answer your question. This is how the comment on the matters to be considered state the audit evidence going to be. Azim, I'm sorry, the auditing standard reference is not mandatory. Okay, so now if you have understood what I actually just referred to, so now what you could do is that you can come to question number . You can come to question number 4 of March and June 2017 exam session. You can come to question number 4 of March, June 2017 exam session. So question 4, March, June 2017. Question 4, March, June 2017 exam session. The name of the question is Osier Company. So please try to attempt this question and then we'll discuss. Okay, now, so this question, which is March and June 2017, question number 4, the requirement of the question is the same as what we did discuss, which is comment on the matters to be considered and state or explain the audit evidence you would expect to find during your file review in respect of each of the issues described above. Now you see, so what do we actually need to do? We need to comment on the various matters that need to be considered, and we need to explain the audit evidence that you would expect to find in our review of the working papers. So now see, first of all, if I talk about case number 1, it says you are a manager responsible for the audit of Austrian company, and the audit is nearing completion and you are reviewing the audit working papers. The draft financials recognize the total assets of 1919 million. Last year it was 1889 million. So what you could actually figure out from here is that there is a growth in the total assets. The total assets have actually grown. Can somebody please share the growth rate for the total assets? The total assets, the change in the total assets. At the same time, revenue of 1052. So if we say revenue of 1052, last year it was 997. The revenue, also the change in the revenue also needs to be actually considered. And profit before tax has actually gone down. You see, the revenue has gone up, but the profit before tax has gone down. 3 issues from the audit working papers are summarized below. Uh, 1.6 assets. Okay, and what about so the asset is 1.6%. What about the revenue? What about the revenue? 5.5%. And what about the profit? There is a decline in the profit. How much is it? 2.7% decline. Okay, so it's negative 2.7%. That's what there in the asset is, in the profit. So now this is what we have. So you see, one thing is the assets have increased, the revenues have increased, but the profits have gone down. Now what's happening? So see, the cost of the inventory, number 1, it says inventory's costs include all purchase costs and the cost of conversion of raw materials into finished goods. Conversion costs include direct labor costs, allocation of production overheads. Direct labor costs are calculated based on average production time per unit, which is estimated by production manager, multiplied by estimated labor cost per hour, which is calculated using the forecast annual wages of a staff divided by the annual scheduled hours of production. Production overheads are all fixed and are allocated based upon the forecast annual units of production. At the year end, the inventory was valued at 21 million. Last year, it was valued at 20 million. Now see, so inventory include all costs, which is the purchase cost and the cost of conversion of raw materials into finished goods. So now let's just talk about this inventory. If I say the inventory of 21 million inventory out of the total assets, so 21 million inventory out of the total assets of 1919 million, gives you what percent? % 1.09% or 1.1%. So 1.1%. That means the inventory is material, 1.1% of total assets. So it is actually a material item. So inventory is a material item. That's number 1. Now, the accounting for inventory, what they have done is they have included the purchase cost and the cost of conversion of raw material into finished goods. Conversion costs include direct labor hours and allocation of production overheads. So the direct labor costs are calculated based on average production time per unit of inventory. Now there is one thing which is very important, that the labor hours should have been based on actual cost per hour rather than labor hours, and at the same time the fixed overheads are also being absorbed using the absorption costing. Now, what happens is apparently they have not actually done anything wrong with the accounting. They have correctly measured the inventory because the inventory's cost is basically the purchase price plus the conversion cost, and the conversion cost is being established, is usually established the way that they have established. So that is all okay with it. But now what is actually the problem is that they have measured the cost correctly. The cost is being correctly measured by them. But now what happens is that you need to measure that the inventory is to be measured at the lower of cost or NRV. The inventory is to be measured at the lower of cost or NRV. The inventory is to be measured at the lower of cost or NRV. And the next thing is basically what happens is, number one is inventory is to be measured at the lower of cost or NRV. Furthermore, the risk actually involved here are, estimated labor cost for the inventory may be different to the actual direct cost of labor on these items of inventory. The second thing is that the fixed overheads the production overheads are all fixed and are allocated based upon forecast annual units of production. Now there is something that IS2 requires, and that is that the overheads shall be absorbed using the budgeted overhead absorption rate. And if there is any under or over absorption, that under or over absorption shall be adjusted from the cost of sale. So now what could actually happen here is that the overheads, the risk is that over/under absorption is not adjusted from the cost of sales. Okay, now, so these are the various things. So you have talked about it, that the inventory is 1.1% of total assets and is a material item, and the cost is being correctly measured, but the inventory is subsequent is to be measured at the lower of cost or NRV. So the NRV needs to be established. The risk involved is that the labor cost for the inventory may be different to the actual direct cost of labor. There is also a risk that the overheads which are under or over absorbed are not adjusted from the cost of sales. So that could also be one of the risks that is actually involved. Now, what next? So if I talk about the audit evidence, so the audit evidence are actually derived from the procedure. You perform the procedure, and the result of the procedure is you have the evidence. You perform the procedure, and the result of the procedure is you actually get the evidence. So now if I talk about it, that what exactly are going to be the audit evidence. So basically what are actually the overall risk involved? The risk involved are that the labor costs may be incorrect. So if the labor costs are incorrect, then what happens is you need to recalculate the labor cost to confirm accuracy. Now, this is actually a procedure that I have mentioned. So how would I actually convert this procedure into the evidence? I have actually mentioned the procedure. How would I convert this procedure into the evidence? So I'm going to convert this procedure into the evidence by actually saying that I expect to find a recalculation statement of labor cost. I expect to find a recalculation statement of labor cost. So this is actually your evidence. Now next is actually the overhead absorption rate. So you need to extract from the budgets showing budgeted overhead and budgeted production. So you would expect to find the extract from the budgets. At the same time, you see, I mean, if I could actually just summarize what I have been telling you with respect to it, is that you need to think about what are the risks involved, and you perform the procedure accordingly, and the procedure would result in an evidence. So if I'm a senior manager or a partner, I'm expecting that my junior would have performed the procedure, he would have gathered the evidence, and he would have documented the evidence in the working paper. And what I am doing is I am reviewing the working papers. I'm going through the working papers, and while going through the working papers, I'm just trying to figure out that has he done this, has he done that, etc., etc. So I was expecting he would have performed several procedures. So I'm expecting that out of the several procedures that he has performed, he would have actually included the various details here. Junaid, materiality is calculated okay. There could also be the cutoff procedures that you might actually check the cutoff procedures. So basically the good received notes could be the evidences that you might expect to find. So the various risk. So overall the questions requirement is about materiality, accounting treatment, the risk involved, and the evidence that you would expect to find. Now next is the next section, which is about the impairment. Now, it says that the year-end, the management performed an impairment review on its retail outlets, which are a cash-generating unit, for the purpose of conducting an impairment review. While internet sales grew rapidly during the year, sales from retail outlets declined. So sales from retail outlet declined, prompting review. At 31st March, carrying amount of the asset directly attributable to retail outlets total 137. This includes both tangible and the intangible assets and the goodwill. During a year, management received offers from parties interested in purchasing the retail outlets for an average of $125 million. They also estimated disposal cost to be $1.5 million. Based upon their experience, management estimated value in use to be $128 million. This was based upon historic cash flows attributed to retail outlets, inflated at a general rate of 1% per annum. This, they argued, reflects the poor performance of the retail outlets. Consequently, retail outlets were impaired by $9 million to restate them to their estimated recoverable amount. Impairment was allocated against the tangible asset of the outlets on a pro rata basis based upon original carrying amount of each of the unit of the asset. Now see, if I could just recall what IS 36 states, IS 36 states that any impairment loss shall initially be allocated to the goodwill. Any impairment loss shall initially be allocated to the goodwill. And the balance amount of the impairment loss should be allocated to the remaining assets on a pro rata basis. So the impairment loss shall be allocated to the goodwill first, and the balance amount of impairment loss shall be the balance amount of the impairment loss shall actually be allocated to the remaining assets on a pro rata basis. That's what IS IS 36 states. Now see, so here if we see 9 million impairment divided by the PBT, we could also say 128 million of the carrying amount divided by the total assets. You could figure out to what extent are we getting the numbers. Can somebody please share? Okay, and what about total assets? Thank you. Now if you see, we are getting percentages of approximately 8.4%, then it is a material item. We are getting a percentage of 6.7%. This is also a material item. So these the impairment loss recognized in the P&L is material. At the same time, the assets are also material items. They are 6.7% of the total assets. So these are material items. Now, if I actually talk about it, so what would happen is that you would say that the above items are material. Now, what does IAS 36 states? In accordance with IAS 36, you would actually identify that the impairment calculations seem to be inaccurate. For the value in use, a specific rate of inflation and specific discount rates should have been used rather than general rates of inflation. The value in use might change as a result of using relevant rate. So that is one of the things. The impairment calculations seem to be inaccurate. For the value in use, the specific rate of inflation and the specific discount rate should have been used. Rather than the general rates of inflation, the value in use might change as a result of using the relevant rate. Furthermore, the impairment loss should have been allocated to the goodwill till the time it is written down to zero, and then the balance impairment loss shall have been recognized shall have been allocated to the remaining assets on a pro rata basis. So basically there is actually a problem with respect to the accounting that they performed. The impairment calculations have not been correctly performed. So they need to revise the impairment calculations. Furthermore, so this is what the risk is that the entity may not rectify the impairment loss resulting in misstatement of financial statements. Now, the evidence as a result of this is basically you need to think about the risk, and the risk were actually with respect to this whole value in use. So the cash flow forecast, management representation for the discount rates, cash flow forecast, management representation for the discount rate, impairment loss allocation schedule. So these are the various evidences that we would expect to find. So basically, the procedures would have been performed, and the evidences that would have been gathered is the cash flow forecast, the management representation for the discount rate, the impairment loss, at the same time correspondence with potential buyers, etc. So that's what you would do with respect to it. Now there is this third requirement, which is about the warranty provision. If I'm going to get into this warranty provision, I would not get time to actually answer your questions. So I'm going to hold it till here, and I would rather prefer to answer your questions, and I would rather prefer to continue this area tomorrow in our class. So in the meantime, for all of you who were actually requesting for the handouts for this Word file, what I'm going to do is that I'm going to try to put these handouts into this try to put this handout onto this webinar so that you could actually get it okay, let me answer the questions that you have. Specific inflation or discount rate Farasat actually means that retail sector is specific. This is specific sector. I mean, you can't have a generalized inflation rate for every single item. You need to have a specific rate. Okay, Ahmad, I will try and share them in the group. Okay, Kaisar, the impairment is in line with the impairment of assets. The problem is that they did not allocate the impairment loss to the goodwill first, and instead they allocated the impairment loss to other assets, which is an incorrect accounting treatment. Radhik, yes. Can somebody please share the link of the group? Okay, Abrar, the materiality percentage are actually, we have discussed about it that the materiality is 5% of the profit before tax. The materiality is 2% of the total assets and 1% of the revenue. Yes, cash flow forecast evidence is sufficient. Omar Perpez, the impairment is charged to obviously impaired asset, but the point is that if there is a goodwill, then the goodwill would always be allocated the impairment loss first. I think Osama Tanvi, the summaries would be shared by my another co-teacher who teaches with me at the Scriber College, Omar Said. He will share the summaries over there. Can somebody please share the link to the group over here? Responses towards the risk is the audit procedure. Osman, I would give you a list of questions that you need to practice. Okay, anyone else has any other questions? Can somebody please share the WhatsApp group link? Junaid, you can get the examiner answers on the website, ACCA website. WhatsApp link has been copied now. Okay. Thank you very much, everybody. We are going to continue tomorrow, and our agenda is going to be that we are now going to move forward, and we are going to, Usman, inshallah, don't worry. I will have a discussion with you. Don't worry. I'll try to fix the problem that you are having in passing this attempt. Anyways, thank you very much.